Well, thank you for that nice introduction. My name is Eric Balchunas. As you said, I'm a senior ETF analyst with Bloomberg Intelligence, and I'm here to sort of break the ice, sort of set the table for some of the main themes that are going on in the ETF world. And before I get started, I want to thank Mackenzie Investments for giving me the opportunity to do this. Canada is a really interesting market. I'm up there quite a bit, especially pre-pandemic. And obviously, you guys are trailblazers in terms of approving new products. So my presentation will lean mostly US. I have a couple Canadian nuggets in there, but largely a lot of these themes are going to happen in any market you go to. So with that, let me jump into some slides because I go at a pretty rapid clip here, and I'll give you some quick takes on the ETF market. So let's start with, there's a boilerplate of where you can find my stuff. So Bloomberg Intelligence, if you don't know, is on the terminal, and it's under the BI Go function, and my stuff is on BI ETF. But I'm one of about 300 analysts there, and I head up the ETF team. So the first take is the ETFs didn't need the Fed's help. This is something that I think the narrative out there was that when the Fed stepped in March 2020 on what we now call kitchen sink day, it's like, they saved ETFs. And I think this is a really interesting thing to point out because, when the market is tough, that's when ETFs really get going. And I think that's where they thrive. The more hellish it gets, the more people lean on them. And this chart of SPY volume really shows that. You can see that anytime there's a really bad day or bad month, the volume in SPY will spike. All ETFs volumes go up. And so I think that is good. I would like to, I like to see volume go up on those times. If volume didn't go up, I would be worried. That means the professional traders out there are not leaning on them for some reason. So high volume in ETFs on bad days is exactly what you want to see, and that's what we saw during the pandemic. $32 trillion worth of trading last year in the U.S. alone, and you can see that the spike in trading correlates, again, to the rougher markets. So that's why I sometimes use ETF volume, particularly SPY volume, as a sort of people's VIX. To me, it's sort of a sign of fear. When SPY volume spikes, that means people are tweaking their portfolios and a little worried. So I think volume is a sign of that. And in the bond space, this is interesting. So there's always been this liquidity mismatch with bond ETFs, but this is a chart showing the discount that LQD had to the NAV on, the first spike down is 2008. The second is the recent pandemic. So yes, you're going to see the price of the bond ETF drift from the NAV, but the problem is the NAV isn't completely up to speed. It had bonds that don't trade every day. And so there's some bonds that haven't been priced to reflect the crisis situation. And so the ETF is trading in real time. And again, the volume in LQD, HYG, and a lot of these bond ETFs was so high, double, triple their old records during the month of March. That shows me that the professional class is leaning on them and happy with the liquidity they offer at the time. So again, I think you got to look at those bond dislocations as more optics than reality. And here's what's interesting. If you look at the bond ETF assets, we predicted right in the middle of the crisis that bond ETFs would double their assets in the next 3 years. This is not an easy call to make because people out there were talking about, ETFs have a black eye now, again, because of that optic of the discount. But look at the assets, how they climb right after the nasty sell-offs. I think a lot of times the volume portends flows. And so when you have a lot of volume in these crisis scenarios, it actually increases the audience. And so time and time again, we see the assets and the interest in the ETF grow despite the sell-off. If anything, the sell-offs actually help their growth trajectory. So again, this is the kind of stuff we're looking at when we see a crisis. And let me go up to Canada now and say that the ETF structure, obviously, if it can hold junk bonds, I think can hold crypto. And we now are seeing the first signs of how good the ETF structure, and we knew this. I mean, I think anybody who tracks ETFs knew that they would be able to handle Bitcoin and Ether. And here's the percent premium of the Ether ETF. And this is with some volatility. And look, it's under its 20 basis points, 13 basis points. That's really good. And I think this is in contrast to the ones down here, GBTC and ETHE, which are not ETFs, and their discounts are all over the place. They range from 10, 20, as high as 40%. So again, the ETF structure is very durable, and I think that's why we will see crypto ETFs down here ultimately, and I hope we discuss that on the panel. US ETF flows could hit $1 trillion this year alone. Obviously, there's the quarterly flows, $250 billion. So you times that by 4, you get to $1 trillion. And you can see how much more it is this year. So where's the extra money coming from this year? And the answer is breadth. Like a basketball team, the bench players are finally scoring. I'm talking about value, small caps, emerging markets. in the past years, we've seen a lot of flows going into growth, tech, right? Those are the superstars. Now we've got some of the left behind areas filling in. And yet at the same time, you still see flows into some of those growth areas. So really, all pistons are firing. And you've got the buy and hold crowd buying their Vanguard and Schwab, and you've got the trading crowd buying their SPY and Qs. So really, it's a really fascinating year. And in addition, again, you've got that nice baseline of flows. So I think generally speaking, there's about $1 billion a day in baseline flows. But then anything over that is sort of more market oriented. And so now there's $4 billion a day coming in. So obviously a lot of adoption going on here as well. Okay, the ETF middle class will continue to grow. Now this is important because in order to innovate and in order for a lot of issuers to be better, they're going to have some success. And so you don't want all the money going to the big three. And I can tell you that it's not true. I think there's a sense that a lot of the money just goes to Vanguard and BlackRock. And while that's true, the good news is there's so much money coming into ETFs that there's plenty of food for everyone to eat. And so here's a look at the number of ETFs that have between 100 million and a billion. And you can see there's 829 in the US. In fact, that's the biggest category. Then you've got 30 million to 100 million. You've got about 500 ETFs there. So if anything, the middle class is the biggest part of the area. Now, that the part on the end, the new guys, there's about 700 that have below 30 million. Some are new, and some have just really not made it. And I think some of those will close, and that's okay. But again, you're going to see a lot of movement from right to left on that screen. Now, patience is necessary, though. You can't just launch an ETF and expect all the money to come in. It doesn't work that way. It's real meritocracy out there. And here's a good chart showing that. Of all of the ETFs launched in the past 5 years, they only make up 5% of the assets, yet they make up 54% of the products. In other words, people tend to put money into the older products. That said, they're taking in 20% of the year-to-date flows, which means they're taking in 20% of the 250. So again, is definitely enough to get going, but as you get older and mature, it even gets better. So again, patience is a virtue for the ETF world, for issuers. And the cost issue is big. In the US in particular, here's a look at the asset-weighted average fee for ETFs versus the average fee. So obviously, the lower the purple bar is, the more that you have people gravitating towards cheap ETFs. And so the ETFs were very cost-obsessed. Here, a little less in other countries, but that is something you will see. People love cheap. Cheap beta is a smash hit, and it will continue to be as far as I can see. One other thing about the ETF market for issuers, and I call it the Steve Jobs rule, which is when he said, if you do not cannibalize yourself, somebody else will. And this is really important. Mutual funds didn't have to do that. But in the ETF world, you have to do that. And here's a good example of RSP, the equal-weighted ETF, was 40 basis points. And then Goldman filed for an equal-weighted ETF. And everybody knew Goldman was going to come in real cheap. And RSP immediately cut from 40 to 20, which cost it $27 million a year in revenue. And then when Goldman launched, they did launch at 9 basis points. But 20 to 9 is a much smaller gap than 40 to 9, and Goldman was never able to get going. And look at RSP. It's now basically increased asset by $20 billion now that equal-weighted S&P is in vogue. And this is a good lesson for the sort of cannibalization that is really key to long-term success in the ETF market. Tesla proves, again, there's no such thing as passive. There really is no passive unless you market cap weight the whole market. And maybe VTI or the total broad market might be passive, but outside of that, everything else is an active decision. So here's my meme, the Zoolander meme, basically how I saw SPY looking at the Qs all year. Both of these are used in sort of beta ways, but they are very different. And I think SPY was very much jealous of Tesla and Zoom and all the really high-flying stocks that were in the Qs, and SPY lagged a lot. And the Qs had a big year last year. So eventually, S&P said, okay, we got to add Tesla. So they finally, Tesla qualified, but they still didn't add it because it's run by a human committee. They finally added it, and you can see SPY really lagged not only the Qs, obviously, but also other, quote, beta large cap indexes. And so this is a real lesson in how, even when you're picking beta, how the index is designed can really affect the outcome of the returns. And I think this would qualify for any part of the ETF world. And the Dow Jones is really a wacky index. The media quotes it all the time, but it's price weighted. And Apple did a 4-for-1 stock split. And so the weighting of Apple went from the top holding to outside of the top 10. It went from basically 12% to 3% just because they did a split. Nothing changed about the company.